You walk into a bank on an ordinary weekday. You deposit your paycheck, glance at the receipt, and leave feeling responsible. Your money is protected. It's earning interest. Everything is fine. Or so you've been led to believe. What if the story you've been told about banks, how they protect you, grow your money, and act in your best interest, is only half true? And what if understanding the other half completely changes how you treat every dollar you earn? Most people assume banks exist to help them build financial security. In reality, banks exist to run a business, and you are one of their most valuable inputs. Let's start with an uncomfortable truth most people never confront. Your bank account protects money. It does not grow wealth. Savings and checking accounts are designed for storage, not growth. Safety, access, and transactions, that's it. Yes, your bank pays interest. But when you compare that interest to inflation, the picture gets ugly. While many savings accounts pay well under 1% annually, the cost of living quietly rises 2 to 3% per year. That gap doesn't feel dramatic day to day, but over time it quietly drains your purchasing power. Money sitting in cash isn't standing still. It's moving backward. Banks know this. They don't hide it, but they don't highlight it either. What your bank does with your money instead. When you deposit money, it doesn't sit in a vault with your name on it. From the bank's perspective, your deposit is a loan you gave them. They take that loan and lend it out again at much higher interest rates. Mortgages, auto loans, business credit, credit cards. You earn almost nothing. They earn the spread. This difference, what they pay you versus what they charge others, is one of their main profit engines. And here's the part most people never learn in school. Banks create money. Modern banks don't just move money around, they expand it. Through a system called fractional reserve banking, banks are allowed to create new deposits when they issue loans. When a bank approves a loan, it doesn't pull existing cash from a vault. It credits a new balance into the borrower's account. Your original deposit still exists. The loan money exists too. That's how the money supply grows. This system is legal, regulated, and fundamental to modern economies, but almost no one understands it while participating in it every day. Credit cards, the perfect trap. Banks love marketing credit cards as tools of convenience and rewards, and they are on the surface. But credit cards are among the most profitable products in banking, and not because of annual fees or swipe charges. The real profit comes from people who carry balances. If you pay your card in full every month, you're not the ideal customer. The most valuable customers are those paying 18 to 29% interest year after year. A $5,000 balance at 20% interest costs $1,000 annually, pure revenue for the bank. This is why credit card offers never stop arriving. The business model depends on a percentage of people staying in debt indefinitely. Why the wealthy borrow differently? Interest rates aren't random. They're a pricing mechanism for risk. The more assets, income stability, and history you have, the cheaper money becomes. This is why wealthy individuals often borrow at rates that seem impossible to everyone else. But the real difference isn't just the rate, it's how debt is used. Instead of selling assets to raise cash, wealthy individuals often borrow against them. Their investments continue compounding, while borrowed money funds new opportunities. When asset growth exceeds borrowing costs, debt becomes a tool, not a burden. This is how money starts working in reverse. Debt grows wealth instead of destroying it. The banking system most people never see. There is a parallel financial system designed for large balances and global mobility. International banking, asset-backed lending, currency optimization. None of it is illegal or secret. It's just inaccessible unless you meet certain thresholds. Banks make enormous profits servicing wealthy clients through advisory fees, international transfers, and asset management. These profits quietly subsidize free checking accounts and basic services for everyone else. The system isn't hidden, it's segmented. Mortgages. The long game banks play best. Home loans are often labeled good debt, and over decades they can build equity. But the structure heavily favors the lender. Early mortgage payments are almost entirely interest. For years, most of what you pay doesn't increase ownership. It compensates the bank. This structure ensures banks recover interest early, even if borrowers sell or refinance long before the loan ends. Paying off a mortgage early disrupts this profit stream, which is why it's rarely encouraged. From the bank's perspective, mortgages are predictable, long-term cash machines. Why confidence matters more than cash? Banks operate with only a fraction of deposits available at any moment. This works because not everyone withdraws funds simultaneously. The system relies on trust. Deposit insurance and central bank support exist to reinforce confidence, not to eliminate risk. As long as people believe their money is safe, the system functions. Bank buildings, branding, and advertising aren't just marketing. They're psychological reinforcement. Fees you don't see but always pay. Foreign exchange fees, overdrafts, account maintenance charges. Many bank profits come from small, invisible deductions most people never question. Currency conversion is especially lucrative. Banks exchange money at wholesale rates, then charge retail spreads to customers, often without clear disclosure. These microfees add up to billions annually. Why financial illiteracy persists? Most people were never taught how money actually works. Budgeting is emphasized. Systems are ignored. Complex language, long disclosures, and opaque pricing discourage curiosity. Confused customers are compliant customers. Banks don't need customers to be unaware, just uninformed enough not to ask deeper questions. The final truth: banks are not villains. They provide essential infrastructure for modern life. But they are not wealth-building partners. Every product they offer is designed to serve their business model first. Understanding that doesn't mean rejecting banks. It means using them intentionally. Use banks for safety, access, and transactions. Build wealth elsewhere. Ask questions. Compare options. Read past the headline numbers. Because the moment you understand how the system actually works, you stop being passive inside it. And that understanding changes everything.